Production. We get the recording. Hey, good evening, guys. Ken and Dan at Tortoise Capital. This is a Research 2023 presentation from Dan on options trading and some other topics. The another version of this presentation and some background materials uploaded in his folder in the Research Weekend. The recording of this will be placed in his folder, but also in the consolidated lesson at the very top of the workshop lesson list, so that you have access to all of the Q&A sessions from one lesson. Make it a little easy. That allows you to download them all and then listen to them on your at your leisure. Copies will also be posted in the foundations course, since we're using some of their time, their office hours for this. Felt it was only fair to give them access. Plus, these are always inspiring for folks that are beginning their journey in the foundations course to be able to see work in progress and what the future can hold for you. And so it gives us something to shoot for. Dan's been working hard in the Super Trader program from VTI. He's been through the foundations course, the Creativity 202 course, for he's going through a second iteration, and has been very diligent in doing the work. And what I really admire about his approach is his perfect accountability for doing things his way, seeing it through his lens, testing every assumption, and trying different combinations and permutations. And so he, I guess I'd say he probably lives by the mantra trust but verify, and strong on math, and has been very gracious about sharing ideas and being vulnerable about the whole trading process he goes through, and so it makes him so there's a transparency and a collegiality to all the work that he does that I find very refreshing and admirable. So you got that to live up to, Dan. So good luck with that. And it's with great pleasure I pass the microphone to you, and I prepare to take my own notes. Carry on.
Sounds good. So save up your questions. I guess feel free to ask them during the presentation. I'm probably not going to monitor the chat while I do this because I got both monitors taken up by PowerPoint. So just raise and option selling strategy presentation. I'll dive in. And here we go. This is my business card. I'm else calls and puts. I'm not doing any spreads or iron condors at this point, although maybe sometime in the future. I know, of course, listening, a website that I have with a few articles and things that Ken set up for some of us on the L site as well. And I hope to add to that in the future. So as Ken mentioned, I started out in the Super Trader program, and then I had been a cybersecurity consultant, still do a little bit of that part-time, but I have to say that trading or investing are my main business these days. And I'm married, living in Silver Spring with two grown sons, a granddaughter, and a dog. Well, actually, the sons don't live with me, but I have the sons. It's an executive summary of my option selling system presentation. So the first important thing to know about it is it's a hybrid of the industry standard wheel strategy and a sort of improvisational or opportunistic covered call selling that I do myself. I've been operating it for about 9 months now and currently meeting my per month profit goal. I have a set of criteria for stocks in the wheel strategy. They have to be stocks that I want to own, and they have to be in a certain technical position. Then also the opportunistic covered call selling tends to be with stocks that I own as part of another system, and I'll get into that, part of my core trading systems. So I got these two systems coexisting together. And we'll talk about the impact of having two systems like that. The most important thing that I had to master in order to make this system something that I felt like I could depend on to produce income and make big bets on week in and week out was risk management. I had to have a good approach to that. So I have a way of tracking the risk to core capital from holding or having an obligation to buy an underlying stock position. And I have a risk threshold for the whole portfolio that must not be exceeded. Now, I mentioned that the wheel strategy was kind of industry standard. I meant that you can find a lot of books about it. And I bought a book about it. And I should also acknowledge Jeff Southern for having told me about it in the first place. I'd heard about it before, but not under that name. And he kind of put the pieces together for me a bit. But I think it's a general sort of strategy, and everyone that uses it probably implements it a bit differently. Mine is probably somewhat unique because I add the opportunistic covered call selling as well. Another thing that one should have when one defines a system, of course, I have a written plan for this, is what are your conditions under which you would determine that the system was no longer working? And so my one of my risk management deals is that I would pause or discontinue the system if it has a losing month or if I determine we're in a bear market.
Hey, let me pause and just ask real quickly, if I may. Definition of a bear market for you? Do you have that as part of your written trading plan as well? And does it vary much from what we've been using here or at Van Tharp's definition?
I have to say that it should be better defined in my plan. Here in my mind, the way I define it is that the way you all define a bear market, the Dr. Ken Long definition is that the SPY is under its 200-day moving average by more than 2%.
Check.
That is I would a little more than that before I'd stop the system, because I might consider that's a good time for me to sell puts. I can get in at a good price. But if it's like a 2020 bear market where it's fallen like a knife, that's when I don't want to be doing it.
Okay. All right. I just want to, we'll put that on the
so it has to be, it has to be bear volatile and have been there in a while. And I could probably quantify that.
Okay. It's just work to be done.
It can't, if it's sort of bearishly sideways, that might be okay. So good question. Good question. So now the next slide here, this is just some basic definitions that readers or listeners of this presentation should have this information in their heads. I'm not going to read through these slides because trying to explain options as a general topic would greatly extend our time here this evening. But these are key concepts that we need to understand for understanding what's an option and what does it mean to sell an option. And I believe that probably all of you here do understand these concepts, but if you have a question, a specific question, don't be embarrassed to ask. But this is here for reference for folks that need it. So my original idea that I had for many years, actually, I would say going back maybe even 20 years, I had this idea that I own stocks and, oh, I could sell covered calls against them, and that's like free money. So I have done that in the past, but never particularly systematically. I would kind of do it a bit here and there, and then I'd stop. Maybe I'd be unhappy that a treasured position was exercised and called away by the covered call. And I also had tried in the past to sell puts, but I had bad experiences with that, and that caused me to not want to do it again. The bad experience specifically was that I ended up getting put a very large position, probably triple the size I should have had, in a gold mining stock. And then in those days, I was not as disciplined as I should be about defining or implementing stop losses. So I took a really big loss that started with an oversized position I acquired due to selling a put. So after that, I was a little scared of selling puts. I was interested in other things like vertical spreads or calendar spreads because they're hedged. But I haven't added those to the system yet. When I started getting back into this and decided early this year that I wanted to get serious about option selling, about generating an income, I knew that what I had to do was really get a handle on the risk management, really own the risk management, understand it, and be ready to stand behind, my own stops and my own position sizing and my own definitions of these things. So maybe I was a bit vague about the bear market question that you asked a little earlier, but I'm not vague about the risk. So here's how I think about risk management for the purposes of this system. I defined three types of risk that you can get into when you sell options. There is the risk to the premium you already collected. If you end up having to close the option or roll the option and you lose your premium. There's also a risk that could occur if you sold a call against a stock and the strike price was below your cost basis on the stock. Then if you end up having that stock get exercised, your loss on the stock will eat into your premium. So there's the risk to your premium. There's a risk to your market's money on the underlying stock. Let's say I bought a stock for $100 a share. I sold a call for $100 a share. Stock goes up to 120, and I'm in the money, $20 a share. Call gets exercised, stock gets taken away. Did I lose that $20? Well, I did lose $20 of market's money. So some people might be concerned with that. The thing I'm really concerned with, though, is the risk to my core capital. If I sell a call on a stock and then it just starts dropping like a knife, and I end up having to sell that stock and take a big loss in the stock, that's going to wipe out anything that I gained stock, and I have my gold miner nightmare all over again. That's the risk that I'm concerned about. And so one thing about this system is that I have to be hardcore when I sell a put or I sell a call. I have to be hardcore about what the stop is on that underlying position that actually exists in the case of a covered call, or implicitly could exist in the case of a sold put. So here's my equation in red for risk. It's the underlying cost basis minus the stop plus your premium per share times the number of shares. That's your risk. And I have that calculated for each position. And for all the open positions I have, I add that up. And the total amount of that risk cannot exceed my risk threshold, or or I don't do the trade. So as I mentioned, I started studying the wheel strategy, and with that and with the definition of risk very clearly specified, and a renewed determination that I would define stops and I would take my stops, I became comfortable with selling puts, which of course you have to do, as selling the put, it kicks off, starts the wheel rolling. So let's say there's a stock that I want to own. Maybe I want to own Microsoft because it's a cash cow and it's an AI champion and all those reasons. And so I could sell puts against it, which is basically saying, hey, if it goes on sale at a lower price than it is now, I'm willing to buy it. I'm happy to buy it. And if it doesn't, I'm happy to keep the premium and sell the puts again. Once I get assigned my shares of Microsoft, now I can sell calls against it. And if those calls expire worthless because Microsoft goes down or sideways, all the while staying above my stop, I can sell calls again and again and again. If, however, we get to the point where, which I'm actually at that point right now, I've got a $340 strike price call on Microsoft, which last I looked was up to 374. And I'm going to have to either let Microsoft be called away, or I'm going to have to roll that call. But if I let it be called away, then the wheel would have completed a full turn, and I could restart by selling puts on Microsoft again, or I could do it on another stock. Now, I add to this that it's very important to define your stop while you're in either the I sold a put or I sold a call stage, and be ready to cover your short put or to hedge it if your underlying position goes near or below that stop. So I got a little bit of a checklist for what I want to put into the wheel. And as I mentioned, it needs to be a stock that I'm willing to hold or own due to its technical and fundamental criteria, its position in the market. It's just basically a stock that Dan thinks is going to be a successful company and is at a reasonable price. And it has to have liquid options available. Typically, these puts, most wheel practitioners and myself would sell them for as short of 3 weeks as 3 weeks. Or if you're in an IRA account, if you're in an outright account, you might go over 31 days in order to get the better tax treatment on your option profits. And I want the premium that I get from selling the put or the call on the stock to provide a 25% or better annualized return. So that means if I sold a stock for, let's say I got an option that expires in 35 days, and I got 2.5% of the stock's price in premium. 10 35-day periods in a year would give me 10 times 2.5 would give me 25%. So that's how you calculate, if you look at any two option selling opportunities, that annualized return kind of gives you an apples to apples comparison of what you're getting by selling that premium. I also have some technical criteria. I don't want us to be in a bear market free fall condition. That's what I kind of described earlier. It can be kind of maybe a little bit of a bear market sideways-ish, but it can't be that free fall condition or or looking like it's going to go into that condition. I want the stock to have a bullish chart, and I would evaluate that on the weekly time frame. I'd be looking for higher lows and higher highs on the weekly chart. Or sometimes I'll take one that's on the bottom of a sideways weekly chart. But ideally, it's in a pullback or consolidation to support coming into the wheel. I want to get a stop that's loose enough that I'm not likely to get exercised, so I could look at the not at my option price, not at my, I have one strike price for the option, which would be my cost basis if I was put the stock. But then I have another price, which is my stop loss price. You can look at the option deltas for both of those prices. So I would want the stop loss to have a low delta, a delta of 10 or, less than 20 would definitely be nice for the stop, a very low delta. And also I'd want to see support, technical support on the daily or preferably the weekly chart. To make it unlikely that my stop will be hit, I want to not have earnings during the lifetime of the put. I need to have adequate capital to fund the assignment of the shares. And my system has to be operating below the maximum risk threshold that I described. I can't have other trades with their stops and their risk adding to this one to exceed my threshold. Once I'm in the trade, I'm generally going to hope to just let the option expire worthless and I keep the premium. It's also not a bad thing if I get put the stocks, but still stay above my stop loss level. Now, if the option price falls to 10% of what I paid for it, then I'm likely to buy to cover, because that means I'm freeing up that risk so that I can put something else into the wheel. So here's my updated system assessment. I did have to update this because I found I'd made some accounting errors, and also I had some new trades. What happened was that I was not, in some cases, I was opportunistically selling calls on stocks, and they were in my core trading system, or they were in my long-term ETF system, or they were in my uncorrelated precious metals system. And I didn't want to have those stocks called away. So I was rolling the positions rather than letting the stocks be called away. If you roll a covered call forward, you may be able to do it in the net credit, but you may take a loss. And I was kind of not accounting for that the way I should have been. I'll just say that. So I redid these stats, and this is the new numbers. It's not a whole lot different from the old numbers. I still have about an 80-20 win rate, and my winners are not quite as good as my losers. That's kind of a characteristic of a system like that, where you're collecting a lot of small premiums, and occasionally you get something stopped out, or you have a big loss on a roll of an option. Overall, the expectancy coming out to 38% of the risk is becoming profit. And the SQN, the raw SQN is 3.3, and the normalized SQN is 4.5. So it's looking good still. I did finally have a slightly losing month in November because I rolled a couple options and I started accounting for that properly. One thing I will hope that I don't have to be in my next life is an accountant, because I'm definitely not that great at accounting in this life. The pitfalls that you can run into, another aspect of what you look for during assessment is the biggest mistake I've made so far with this system is to sell a put on a stock I didn't really want to own. And that one was Tesla. I was drawn in by the volatility of Tesla, which meant I could get a nice fat premium. But although, there's definitely things to like about the company Tesla, I felt like it was too richly valued to be a fundamental buy for me. So I didn't really want to own it long term. And so when my stop, when it started doing its volatile thing and it went below my cost basis and it's going down, and I'm even thinking it could hit my stop, I ended up getting out at a loss. And that was kind of one of my bigger losses with this system. And it was all because I had weak hands for Tesla because I didn't really want to own it. Contrast that with Exxon, which is one that I want to own. And I still own it in the farm, although I don't have an active trade on it at the moment. And it's kind of flirting with my stop, but it's gone down close to the stop like twice, but it hasn't closed below my stop. So I'm still holding my breath on that one, and I'll hold it till the bitter end of closing below the stop. You want to for this system for my implementation of it, you have to want to own these stocks if you put them into the wheel. And the other one that I think I've solved is just failing to measure risk and loading up too many positions and running into a bad patch, where the market goes down a lot and you get stopped out of a bunch of things at once. Somebody had this wonderful expression that I heard. You don't want to have a system where you eat like a bird and crap like an elephant. So that's always the risk with these high win rate, higher average loser systems. So busy trying to avoid that. I track everything in a dashboard here. This dashboard shows my open positions and my closed positions. And you can see in my open positions, I've got my cost basis, which is either the cost basis of something I've had for a long time, the original cost basis. A lot of time, though, if I just sold a put on something like I did here with Microsoft and Toll Brothers and Tyler Systems, the cost basis is the same as the strike price of the put I sold. And I've got my expiry date, my option premium, and the most important number here is the net core capital risk if stopped out. You can see I track that here. I've got risk here in the low teens, and it's still slightly below my threshold at the time. That's the most important number. And then I track the closed positions. I track the total premium, the per month profit, and the profit per day. And, I have objectives for those that I'm trying to live up to. So my next steps are, I want to keep meeting my objectives. I want to keep being able to raise my profit per day and profit per month. But while I'm doing that, I want to lower something. And what I want to lower is the percentage of market's money that my risk threshold amounts to. So right now, my risk threshold is about a little below 50% of all the money I've ever made with that system. So that means there is a possibility that we could have a serious market correction. Like in 2018, the market went up kind of vertically, like it's done now, but then twice that year it had 20% corrections. So something like that could take out all my option positions. And if that happened, that would take out all my risk threshold, and that would mean half of everything I ever made from this system would be down the tubes. So I would like over time to increase my markets money to double what it is, say, but only increase my risk threshold by a little bit so that my risk threshold eventually, while still rising to enable me to have a higher per month and a higher per day profit, my risk threshold still is now, say, 25% of all the market's money I ever made, and eventually only 10% of all the market's money I ever made. So that's what I'm working towards with the system, and the risk dashboard, kind of gives me the way to do that. I want to have more specific rules, tighten up on my definitions, criteria. Ken already found one thing that was a little loose. I want to track annualized gain and reward to risk more formally and strictly. I want to have a strategy to hedge short put positions that go into the red so that I have an option to maybe hedge instead of sell at a loss. And I want to add, I put add vertical spreads and calendar spreads to the system, but I'm thinking maybe they might be a different system. But that's the end of my prepared presentation. Let me just stop right here and see if any questions came up during in your minds during this part. And if not, I can go to the ones that
Hey, while we're waiting,
had
to see,
put in the
oh, there's
camp.
one in there, in the chat,
Mhm.
from Greg.
Okay.
I'll let you, can you see that in the chat? I'll let you read it.
Yeah, I should be able,
Yeah,
if
oh,
I
let me
stop
read it just in
sharing, I can
case.
see
I
it.
don't know if that
Yeah,
shows in the video of this thing, so I'll just read it.
yeah.
Greg asks, when you offer your option, do you consider also buying a counter option at that time, close enough to protect possible unlimited risk? Are you waiting for a 10% move before taking action? How are you protecting yourself to limit to a 1R loss at the time of the trade?
So the R is always the distance between the strike price and or the cost basis of the stock, either the strike price of the put or the cost basis of the underlying stock, and the stop loss point. That's always the R, and it's and so I would protect myself from having a greater than 1R loss by taking my stop, by not selling puts during earnings. Uh, um, that would be the best I could do. I could always gap down to a greater than 1R loss. I'm aware of that. As far as what you described, I forget the exact words you used, but it was the same thing that I was talking about with hedging and with defending the short put position. And that would be you would establish a long put position at a lower strike price, basically turning your short put position into a vertical bear spread, because you'd have a higher price short put that you originally sold, and that's now hedged by a lower priced long put. Uh, and and that could also be a vertical bearish calendar spread. You wouldn't necessarily have to buy the long put for the whole period. And I think I've got a slide where I can show what that might look like. Where is it? Yeah, down here. I'm still sharing, right?
Yep.
Let's see. Oh, it's not this one. Okay, let me put this back up. That was a little while ago. So, um, example, suppose I have a VTI 225 put on this option chain shown here in the on the screen. Let's get this junk out of here. There we go. And my stop is at 202, which is around here. And my option was sold here at 225. So there's with VTI, there's 4 or 5 strikes down to my stop. At this point, if I got a $2.40 premium on that 225 put, for 15% of that amount today, I could get a VTI 205 put. Uh, which would hedge me. I wouldn't have to sell put because it would be growing the loss on the short put. I could basically exercise them both if I wanted and limit my loss. So that, but I could only do that now while VTI is still up at 225. If I wait till VTI is already down to 215 or 210, that 205 or that 200 option isn't going to be available for 30 or 40 cents anymore. So the idea would be, if I wanted to devise a formal strategy for how I'm going to defend these puts, rather than just saying I'm going to have a wide stop, and if I get hit on that stop, I'll just suck it up, which is what I do now. If I wanted to defend it, I would have to have a formal strategy that says, okay, let's say VTI was 226 when I sold this. If VTI comes down to, 223, now I'm going to invest that 15% in my hedge. I would have to have some kind of rule like that, and I would have to implement it. And I could, depending on how many options were sold, VTI only has these monthly or quarterly options, so it's not a good example. But if you have a stock like Apple that's got weekly options, you have the whole calendar to work with. You could say, well, it looks like the whole market's going into a correction, but I'm thinking that will only last for a few weeks. So I'm just going to get a short-term hedge. And then I'd have to have another rule that said if gosh, it looks like I was wrong, and looks like this correction is not short-term, but my hedge is running out. And not only that, a new hedge would be too expensive. It would eat up all my premium and more. At that point, I might have to say, okay, that didn't work. Now I have to sell or cover. In the case of the put, I should say cover. So I hope that makes a little bit of sense, but it's my preliminary thinking on it. The 15% figure was an idea that I saw somewhere in my research that some other option traders use for, as a guideline for the hedging. It makes the system more complicated. And I've so far I've been doing well with it without having the hedging.
All right, let me ask a question about market conditions. Bull versus bear. When you're making that judgment about bull markets versus bear markets, are you looking at the broad market itself, or are you looking at like a market classification of the stock that you're proposing to use the option on? In other words, if you were doing VTI, are you looking at the S&P for bull or bear, or are you looking at VTI well, which is, you know,
Yeah, well,
is that the
VTI
ETF?
is,
Yeah.
yeah, yeah,
Okay.
VTI and S&P track pretty
Yeah.
closely.
Yeah. I was
But,
thinking of,
but yeah,
where you had the like individual positions like gold,
yeah,
Toll Brothers, Tesla.
yeah.
Are you looking at market conditions broadly in the S&P, or the the individual condition of the stock itself?
I'm looking at the stock, but the only time I'd look at the broad well, I guess if we went into a bearish market again and it looked like it wasn't, you know, kind of just going sideways bearish, um, and then kind of going back and forth and chopping around, that would be okay. But if it's continuing to go lower, uh, then I would have to consider not taking any. I would have to
Yeah.
stop taking
So at a
positions.
certain point, it's a
Um,
combination really
of
of.
that, unless they were. Sorry, go ahead.
I was going to say then it sounds more like a sort of a combination of broad market condition plus the specific context of the stock, unless you had something like gold, in which case you might say, "Hey, I'm looking at gold as a separate entity because it doesn't always track either correlated or uncorrelated with the market, or inversely correlated. Its correlation will actually vary over time. So something like that, you might uh, use a slightly different lens than something like Toll Brothers, where
Yeah.
you might be looking at both the market and the stock. So the next thing I
Well,
would say is okay. Go ahead.
I was going to say gold or energy has been kind of uncorrelated with the market over the last year or
I've
two as
noticed
well.
like finance tends to, the sectors that I track in addition to the market. I mean, I look at, as you know, I look at four sectors. I look at energy, finance, materials, plus the tech sector itself. And I look at tech and the market as being almost always strongly correlated. But energy, finance, and materials tend to operate, they can operate independently of each other and independently of the market. So I might, if I was looking at one of those as a candidate, I might vary the way I consider market and sector conditions before I took the trade. So, so now related to that, has to do with selection criteria for ownable candidates, and that is, have you given any thought to deciding on a an array, a sample of portfolio members to consider, like a short list of things that are like always on the table, and then you're kind of monitoring them to see if they're coming into a scenario in which they become suitable. In other words, uh, I was impressed that the list of open and closed positions you showed had quite a diversity of holdings. I mean, there was gold, there was Toll Brothers for home builders. There was the S&P. There was gold. There was Tesla. So those actually seem like a pretty least correlated set of things to hold, so that you're getting some portfolio diversification as a risk. And so I'm wondering if you are you doing that deliberately, or what's the process that brings something on your radar to consider as a candidate for this strategy? I know you said it was
Yeah,
something you wanted to own, but are there other things that you look at?
yeah, you're right. It has to be something that I can be convinced I'd want to hold long term, and be perfectly comfortable being, 10% or 15% underwater on it for a while if I had to,
Yeah.
while selling options to ease the pain of that. So it has to be something I'd want to own. But you're right. I do look for a bit of diversification. There are a lot of stocks in the tech sector that I'd like to own because technology's
Yeah. So
a great
yeah,
sector, and
here's
because
like a
I'm
thought
kind of a
experiment.
technology guy
Yep.
myself. But I don't want to own all technology.
Right.
That's why
So
I
here's a
have
thought
some
experiment.
energies, technology, and others.
Okay, so here's a thought experiment. This is this the kind? I'm not much of an options guy myself, but so I would think of like a scenario whereby just yesterday, Oracle, which is it's an XLK component. It's a S&P 100 component. It's a big player in tech. It's mature. It's like Microsoft and Apple in that sense. Long-term positive cash flow, a staple of B2B and B2C technology. Well, they just had a 10% sell-off after an earnings call, and now they're a long way away from their next quarterly earnings, and they just took a haircut. So a person could argue, like me, I might say, hey, well, I think the froth has been blown off. And the price that they've now discovered is a price that already reflects any intermediate term risk to the price. So if I started with something that's a great American company and has already experienced the blow off, and they're not going to have an earnings call for another 3 months, and it's a good company, and today the market showed a really strong signal in reaction to the Fed that, hey, 2024 is going to kind of be bullish, is the current interpretation. Well, maybe Oracle, because it's already had the haircut, is in a position to be able to do something long term. Like I have some risk mitigation because it's already been beaten down. In the same way that Walmart uh, has had a 8% sell off here in the holiday season, is now just starting to show some buying interest. Are those the kind of do those kinds of tactical considerations influence the targets that you might use for this kind of a system?
They do, although I like your idea of kind of having some a screen that kind of looks for the oracles that reacted badly to earnings. Things that come on to my radar screen are a little bit random. There's another slide that I prepared. How do I find opportunities? I've got a tool called Options Play, which is available. It's actually available with Fidelity.
Yeah.
Um, and for a small monthly fee, um, you can put in your criteria: aggressive, moderate, or conservative, and your time frame. 30 days, 45 days, 60 days,
Yep.
and your watch list. And so I just put together a watch list with the top 120 stocks that are the top components of the XLK, XLV, XL, all the XLs. I just put that in, and it's such a big watch list. I had to have three of them, but I just run through them, and
Yeah.
it'll give me the sorted, like right here, of 1/3 of those 110 in this particular list, Alcoa. I guess because this is the A through F or whatever.
Yeah.
Alcoa's got the highest annualized gain, and next is AMD. Um, and I actually ended up selling some puts on Cliff because it was 24%, so it was almost
Yeah.
25%.
Yeah. I mean, I'm
Uh,
also thinking like
eh,
I could imagine how if you're looking for some long-term price protection, sort of as a implied defense, things that are like in the Berkshire Hathaway portfolio, so like a Coca-Cola or an International Paper or Waste Management. I know like Bill Gates and Buffett both have large positions. They have some dividends, and seem like stable companies that give you some downside protection as well. That whenever they're in a favorable buying position long term, if it then becomes, I'm wondering, do your screens or does this tool allow you to pick those kinds of things where you have sort of like a macroeconomic view or fundamental view of price performance in the next X months?
Well, the trouble with Coca-Cola is that it's probably got a pretty low beta,
Yeah,
uh, and it's not going to deliver a 25% annualized return,
yeah.
you know.
So the
So
Buffett stocks then probably don't make a lot of sense in that regard. Whereas something
Walmart,
like a
I want to
Devon
look at
Energy.
Walmart. Yeah,
Yeah, so
Devon would probably work out here.
yeah,
Yeah.
because I'm thinking like Devon and Cliff, and I might actually look at Intel, and only because of the change in the business model of semiconductors with the technology coming home domestically, and they are really well positioned to take advantage of government spending, and they have been under price suppression for a long time. So I can, I guess the next thing is, you were talking about looking at stocks, I think, in the window of the next 1 to 3 months, so that there was not an earnings call in there. Is there, and I don't know enough about options to say, but like long term, like leaps that give you more of a time horizon to be able to collect premiums for longer term. Has is that anywhere in your radar screen or for your planning considerations?
No, uh, 3 to 5 weeks. If the shorter the time, the more likely it is that I can just collect my money and get
Okay,
out of the
okay.
get out of the trade and do a new trade.
I
The
think
thing,
that makes good sense, given that what we've seen after COVID is that the volatility has been greater, but also of shorter duration. So you're getting sharper peaks and valleys more often, which means that being able to play those swings um, to gain cash as the options prices change, it probably favors the shorter duration trades in this
also
strategy.
the time decay
Yeah,
phenomena. Most of the
yeah,
time decay occurs in the last few weeks or days
yeah,
of the option's lifetime. So when you're selling options, you get to keep that time decay.
yeah. Now, as you consider this as one of the systems in your meta system approach, um, what, do you give thought into how much of your overall portfolio to allocate against this as a way to sort of put a lid on the risk associated with just this system?
Well,
As
I haven't had to. There's been plenty of money available to put into this system because until um, November, I didn't feel like we had a bull market so I can have stuff in the money market earning
right,
4 or 5%, and it's still fulfilling the margin requirement to support this system.
yeah.
Uh, so I can put as much money as I want into it. Uh, my constraint has been the risk threshold, not the capital.
So this is a opportunistic system. For example, when maybe the longer term relative strength systems like the core and the BMR, those went through about a 6 month period when the overall exposure of that long term system was very low. I mean, 10, 20, 30%, and it was carrying like 60, 70, 80% cash for months at a time. Well, then instead of just having that cash sitting there, then am I right in saying that then that might be a candidate for this kind of shorter term periodic opportunity trade to raise some capital? Is that
Yeah,
fair shot?
absolutely.
Okay.
I think if we had if the strong bull market continues and BMR continues to be at 100%, it's an excellent system to put IRA money into.
Yeah.
It's
Okay.
not terribly tax efficient. In my case, I kind of have more money not in the IRA. And so if I'm to do a core system, I either want it to be kind of a swing trading sort of thing where it's getting high profits,
Yeah.
or else it's more tax efficient. Um, and so I haven't been putting, I kind of regret not putting more in to my core systems in the beginning of November, because
Yeah.
I didn't think we'd be here where we are today. So
Well,
I've just been doing
to be
this.
fair,
But
that last
this,
30 days has been a historically amazing move. We haven't seen that for
yeah,
at least 3 years. The last
it's
time it
kind of
moved
the,
that far that fast was after the first reaction against the uh, COVID sell-off. That first burst off the
yeah,
disastrous bottom was the last time that we saw a 30-day move that was as strong as the one that we just that we're in, and is still working today, and may continue based on if there's any follow through from the reaction to the Fed, sort of a relief rally. The other side of that is, if you're
yeah,
cynical, um, to keep the political shenanigans a dead heat, the current administration needs a demonstrably improving economy in order to counteract the Trump phenomenon. That there's so many negative things associated with Biden, that the economy, even though the numbers on it are actually looking pretty good, there needed to be something economic that would be beneficial. And so, lo and behold, in December, 10 months away from an election, now we've got what looks like a commitment for the entire year of 2024 for 75 basis points in interest rate cuts, which will be interpreted as a positive sign for the economy. So, I mean, and that was going to be my final question was, you know, are you incorporating any kind of longer term macro forecasting or predictions for the market that that has you put more or less money into this strategy as opposed to just funding the long term BMR, for example? Is that a
yeah.
choice that you have to make with loose cash?
I will if, if so far this system does not require a huge amount of capital that I have, so I could do both at this point for a while. But there's also your psychological capital. What do you
Yeah,
spend your time thinking about? This is a good one that it doesn't take a lot of time, but it takes some.
yeah,
And I will say that selling covered calls is not the best strategy during a raging bull market. You're better off just holding your stocks and
yeah.
selling for profits.
Well,
Um,
yeah, I'm reluctant with 2.5 World War III's underway, and COVID, next generation, always on the horizon, and two 80-year-olds running for president with lunatics as their number two. This is not a time when I'm, ready to just comfortably say, yeah, the next 4 years should be smooth sailing. I think those days are kind of over.
I'm the same way.
Yeah,
I find it. Um, Part of me just wants to say I got to look at the chart, and forget about the politics. There's always politics. We're always climbing a wall of worry.
you know.
We can climb a wall of fear too.
Well, I would
But
just notice
yeah,
that, pre-COVID and post-COVID, that the time frames for short-term and long-term seem to have changed. Like, I can imagine that there's a group of people before COVID who thought, well, I'm gonna, in my conservative portfolio, I'm gonna make an annual rebalancing, and then if I want to be turbo or aggressive, I will rebalance quarterly, with some turbo or growth portion. But I could see how those people could look at the way volatility cycles now and say, you know what, I'm going to be a quarterly rebalancer for long term and monthly for short term, where the more rapid reaction to changing market conditions makes folks just move sooner. In the same way that 10 years ago, it took a 10% sell off before institutional money would start hedging against a bear market, which kicks in traditionally at 20%. So if the bear market was officially 20%, at 10% correction, you could see them starting to make real decisions to hedge.
Yeah.
Whereas anymore, it's almost like 2.5% and 5%. The decisions to start moving large chunks around is coming at earlier and earlier sell-off levels, and that's leading to the kind of increase in volatility that we're seeing, the cycling volatility that Risk Z helps us with. By the way, that would be the other
Yeah.
one. I would think the Risk Z might be something in there that gives you insights into the next 3 to 5 weeks for potential bull versus bear conditions. Okay. Well,
Yeah, that's a good idea.
I have us at around at 8, a few minutes after 8, and I want to give the guys on board here a last chance for questions before we wrap this up and get ready for the 8:30 podcast. And with again, if there are additional questions if you're in the sound of my voice on this recording and would like to forward some questions, we'll send them to me and I'll get them bundled up for Dan, and we'll maybe try to do one more follow up after people have had a chance to digest some of this.
And we have a discussion area too, I think.
Yeah, and there's discussion, and what I would do is if they send me the questions, I'll consolidate and put it in the discussion, or they can just add it right into the discussion, and then if you're checking that periodically,
I will.
you can respond in a dialogue right there. That's a good place to have conversations that are specific to this concept. So, seeing no other questions, I'm going to say thanks so much, Dan, for
You're welcome.
stretching my mind and taking on this challenge of looking at sort of alternate time frames and alternate strategies that we don't often talk about. I would point out that Danny Ben Yair, who's a super trader graduate, also a hedge fund manager, and who coded all the TC 2000 package for us, also created a options trading course that was geared towards implementing ideas in support of our swing trading course. The mechanical swing trading. He's got an 11 lesson course that is geared towards that. He's got that on sale for 40% off for the remainder of 2023, and he uses that in the management of his hedge fund, and it's bulletproof a way to approach options as well. Doesn't use this strategy, but he has some. He has 11 different lessons and different strategies that work in tandem with swing trading very nicely. So I want to bring that to people's attention. We don't talk about that enough, I guess. So going once, twice, and 3 times sold. Thanks so much, Dan, and we shall see you soon. Keep up the great work.
Thank you. Pleasure.
Thanks, Dan. Have a good night.
Welcome. You too.